Do mortgages have to be a very frustrating process? I know it was for me, and I want to make sure it's not that way for you. Today, I'm sitting here with Jim Gaffney of Union Home Mortgage, and we're going to go into some of the top questions for buyers and sellers in the mortgage market. Everyone is saying wait for the rates to drop, maybe further into 2026. We know Jerome Powell has cut mortgage rates already a few times, well, federal rates a few times, which doesn't necessarily correlate to mortgage rates in 2026. They're scheduled to drop maybe one or two times, they are predicting that, but is waiting for the bottom actually the most expensive mistake a first-time home buyer might make?
Yeah, it's a little bit of a loaded question, but the short answer is it's always a good time to buy if you plan on staying in the home. So there's a quote by an author of a book called Automatic Millionaire by Debunking. He says it's not about timing the market, it's about time in the market. So waiting for interest rates to drop could actually position you in a worse position, because when interest rates drop, if they drop substantially, that pent-up buyer demand, we have millions of people waiting to buy right now, and they're not. They're waiting on different economic factors, and what's going to happen is those people are going to enter the market when interest rates drop. So we start seeing 5.25% interest rates. Now you're flooding the market and you're raising those home prices back up. You're going to lose out on the seller concessions. You're going to lose out on the seller fixing the hot water heater or replacing the roof or negotiating with buying your interest rate down for you. So it could actually be could actually work in reverse, where if interest rates drop substantially over a short period of time, and it could actually cost you more for the same house today, where we have sellers more likely to negotiate.
I know, in Hillsborough County alone, they say if interest rates drop below 6%, 65,000 more eligible buyers will be able to enter the market. And while this does seem like a good thing, they will be competing with you if you want that mortgage. So we also hear the phrase, marry the house and date the rate. Or Jason Hartman is very famous for refi till you die when it comes to rental properties. But what are the hidden refinance traps that homeowners miss when they assume they could just swap their rate in 6 months?
Yeah, and that's important, especially right now, because we're hearing in the media that rates are coming down, but does that mean that it's the right time to do a refinance? So if you're going to refinance your home, there's an industry standard that we recommend that you're recovering the cost to produce that refinance within a 3 to 4 year period. So let's say within 48 months. So what does that look like? That means if I have closing costs of $4,800, I'm saving $100 per month as a result of getting that lower interest rate. That's a 48-month cost to recoup. What we see is lenders soliciting, we see like they're vultures out there calling people, trying to get them to refinance, and they're charging in fees and discount fees, $10, $12, $15,000 to refinance, and they're just eating up so much of that person's equity without really consulting what their long-term goal is and whether or not it's a benefit for them to save $150 a month, $170 per month. Does it even make sense for them to do that? Sorry about that. Does it even make sense for them to do that? We typically don't want to refinance someone to save $140 a month. It's just not worth the effort, worth the equity investment. So saving more money, like a beneficial amount that's going to check the box and really turn the dial on monthly savings, is going to make sense. So don't refinance without really going deeper around how long you're going to stay in the home for, what the cost is going to be for you, and how many months it's going to take you to recover the cost that it took to produce that refinance. People don't look into the cost, they just look into the savings. And a lot of times one more thing, you're also re-amortizing the loan over another 30 years. So you're 2, 3, 4 years into a 30-year term, you go, I could save $200 a month. Well, they just added 4 years onto your mortgage. You're now paying so much more money in interest with every payment, even though you're saving money, and ultimately you're paying so much more for the home.
So if you say that maybe it was more of a short-term play, that they should just do a HELOC for what they're trying to accomplish?
Yeah, if it's a debt consolidation piece, then I would highly recommend a home equity line of credit. There's a whole other episode we could do on debt consolidation, debt management. But if you're trying to take cash proceeds out of the home to pay debt and you have equity, and especially if you're at a low interest rate now, just look into a home equity line of credit. It's a great way to consolidate credit debt. But if you're in a home mortgage and your interest rate today, we're in December of 2025 when we're filming this. So, if your rate's over like 7%, probably a good idea to start looking at refinance opportunities for those people hovering in the 6s. Today's pricing just doesn't warrant going through that effort to go from 6.5 to 6%. Just as an example, on an average loan amount of $400,000, if you reduce your payment by 1/4 of a point, that's about $70. So for someone to go, let's say from 6.5 to 6.0, that's about $140 a month savings. And for the person who's owning a $400,000 home, saving $140 a month, it's not exactly what they would really need to see a difference in their cash flow monthly. That's a couple trips to Chick-fil-A, and we're gonna recommend holding out for a lower interest rate environment.
Okay. Now on to down payments. In a market where prices are still kind of high, it's still a little bit of a seller's market, is 20% down payment rule officially dead? What are the high leverage alternatives that really make sense for a first time buyer today?
Yeah, great question. It's probably the most common question that we get in the industry is that, do you need 20% down? Or when we speak with potential home buyers, they say, well, I'm waiting to save up more money for my down payment, when they already have the minimum down payment. So we can lend with as little as zero down. There's programs out there right now, multiple programs, especially in the state of Florida, that will allow a home buyer to purchase a home with 100% financing. So you don't have to be a veteran. You don't have to have any special circumstance to you other than just qualifying for a standard loan. Most of these are FHA loans, what's called FHA. But you can qualify with as little as zero down, 3%, 5%, 10%. So there's a loan program for anyone, but the myth that you need 20% as a down payment, that's going back to the 1980s, doesn't exist anymore in today's environment. So if you're interested in buying versus renting, you don't need a whole lot of money for a down payment.
Well, that's good news to hear. And I know that I've been researching down payment assistance programs, and it often goes by your zip code. So if you give me your zip code, I could put it in and I can see which down payment assistance programs might be available for you in your area. It all is very area specific. So let's just say the person gets to the table, the closing table. Most buyers budget for the down payment, but then get blindsided at the closing table. What are unseen fees at Union Home Mortgage or any mortgage company that buyers need to prepare for so their deal won't collapse?
Yeah, another great question. Closing costs. A lot of people don't understand that when you purchase a home, there's going to be closing costs. They're no longer rolled in. We used to say, oh, they're rolled into the loan. That's not the case in today's environment. We can request the seller to pay the closing costs. That's a nice feature to the allowances that banks have, is that we can actually have the seller contribute towards or pay for a buyer's closing costs. If they don't, as far as surprises, it's really uncommon in today's environment. Maybe about 10 or 12 years ago, there was less restrictions on disclosing. So more buyers would get to close without having seen disclosures or seen estimates prior to that point. So in today's environment, we're disclosing day one, we're disclosing after the loan approval, we're disclosing closing fees 3 days prior to closing, and then we have our final closing document that we do in a pre-closing consultation. So, just work with the lender who's communicating. If you're a buyer, work with someone who's going to disclose what your fees are. And ironically, looking at closing costs, people think it's the bank's fees. So when they see closing costs, they say, oh, my closing costs were high. They were whatever, $12,000 or $15,000. What they don't understand is that the bank is only one very small portion of closing costs. The rest of your closing costs are going to third parties completely unrelated to the lender. So you have your mortgage taxes, you have your escrow collections, which is your taxes, insurance, your property taxes, and then you have your bank fees, and then you have your title fees. So the bank represents such a small amount, really uncommon where we have people get shocked anymore at closing for hidden costs. It's too compliant. Every cost has to have an associated credit and debit to it, an invoice. So there's not really much fluff at all in closing costs nowadays.
Yeah, I know this personally happened to me when I was about to purchase a home in the early 2000s. This was pre-2008. And they did not have what's called the Alta disclosure, which has all those closing costs on it. And as like Jim said, that you get those closing costs at minimum 24 hours in advance. Well, I went to the closing table and they slid a paper in front of me and I looked and the interest rate was different and the closing costs were way higher than I had expected. Well, you know what? I lost my escrow, I got up and I walked out of the room because I wasn't going to accept it. But it's a different world because consumers really had their say in this. They sued, and unfortunately, or fortunately for buyers in this case, litigation did pan out in favor of the buyer having all the information that you need before you sit down at the closing table, which is really great. So if a viewer has, let's say, a 620 credit score today, what is the single fastest way they can game the system to qualify for a better tier before they apply with you?
Yeah, good credit management. So pay on time. Number one, don't have a late payment. So it's critical, like absolutely critical, that you pay on time. When you have a late payment that goes over 30 days late, that's a massive trigger that will decrease your credit score overnight. So paying on time would be the number one thing. Outside of that, what can you control if you're already paying on time? And the answer is debt usage. So take a look at your available credit limit and take a look at what your balance is relative to the available credit limit. So, Angelique, you can actually pay down a credit card today where you may have a maxed out, we'll call it maxed out balance, right? So you can actually pay that credit card down. The lower that you pay it down, the more that your credit score will improve within a matter of days. So for example, if someone has a credit card to, let's say on a Target for $500 and they owe $490 on that card, we're going to call that at 99% usage, or another term we would use is that you're maxed out on the card you have very little available credit left. That's a perfect example where you can control your credit score and pay down that balance to a much lower figure, maybe $100 balance remaining. That's going to increase your credit score rapidly. And also just don't have a lot of credit inquiries if you don't have to. Certainly if it's a necessity, great, but opening new credit, advancing new credit, inquiring about new credit in a short period of time can also affect your credit score as it relates to risk. So minimum credit score retrievals, pay down your balances if you can, if you want to. I use the word manipulate, or create a higher credit score on short notice, and then pay on time. Those are probably the three biggest factors to maintain and improve your credit score.
Great, because I know that when I did my research for the title video, which I published last week, is that it doesn't necessarily apply if you are shopping for a home mortgage. So they do give you about a 45-day window if you're shopping for loans with a mortgage company so that your credit score doesn't take a hit. So this is basically preparatory advice before you apply for a home loan. And does that credit score, or does the credit usage apply to individual credit cards, or does it take all of your credit cards and aggregate that balance?
It's individually.
Okay.
So it does both. Actually, your credit report shows each credit card individually, and it also will show your credit debt as a sum, and it will also include other debt, like installment loan debt. Most people have car loans. So it's going to accumulate all of your consumer credit debt, timeshares, student loans, installment loans, credit card debt. It's going to add all of those up, and that's going to become your total debt. And then they divide that total debt by the total available credit limit. So that can get you in trouble. A new car loan will actually suppress your credit score because you're typically at the maximum amount due based on the available original credit limit. So you get a $20,000 car loan, month number one, you owe $19,500. So that also has the appearance of being maxed out, and that can push your credit score down. I will say that if you have an old credit card that you've had for a very long time, don't close it. The longer that you have had a credit card, we call that seasoning. It's a seasoned credit card. It has history to it. The seasoning of a card, the depth of how long you've owned it for, do play a role in your credit strength. So some people will say, oh, I don't use that card anymore, I'm just gonna close it out. I've had it since I was 18. That credit card is actually helping your credit score every month improve, because every month that it seasons or gets older is another month of strength of having credit history. So don't close out an old credit card if it's paid on time. If it's not paid on time, that's a different topic. You wanna address that.
Yeah, so keep those credit lines open unless they close them for you, which some do. But if you could just leave it in a drawer somewhere and just get the new card and put it somewhere in a drawer and not use it, you're building up that history, which is incredibly important. You specialize in building wealth through homeownership. And can you show us, or just give us a concept of the math of what does a net worth of a renter look like versus a homeowner after 5 years in this economy headed into 2026?
Sure. So renting versus owning. There's a lot of math that can be brought up around that topic, but in short, someone who's renting a home essentially is paying, what's the saying? You're paying your landlord's mortgage payment, right? So when you're renting, you're not building any equity. Rent's kind of linear. You want to see the same rental amount from month to month. Year over year, you're typically going to get a small rental increase. So you're increasing the cost of living for a home, and you're not taking, there's no equity, there's no value that you're getting out of that as far as an appreciating asset. So move over to home ownership. With every payment that you're making, you have the opportunity to build equity. It might be a small amount starting from payment number one, but every month that you're making a payment, you're chipping away at your balance, so you're making forward progress. Also, homes appreciate. Traditionally, in the last 81 years, home values have gone up 75 times, and home values have gone down 6 times. So if I'm looking at renting versus owning, and I'm looking at historical data, I'm saying that if I own a home, there's a good chance my home value is going to go up. Then you start to bridge what we call equity, which is what your balance is. So your balance is decreasing every month, and your home value is increasing every month, every year. So this gap right here becomes your equity. And when you sell the home, that will come back to you in the form of proceeds, in the form of a check, a profit. You can leverage it to borrow more money at a later date if you're interested in being an investor or purchasing another home or another product, service, etc. You have access to get that money back as a leveraged amount, whereas as a renter you can't. There's a lot of data around home ownership, even down to someone's health, that people who have home ownership are healthier. They have a higher net worth. They have a higher statistics around family cohesiveness. There's a higher likelihood for people with home ownership to have nuclear families with 2 spouses in a relationship, versus renting. There's a higher divorce rate for renters than there are for homeowners. So there's a lot of data going right into more personal things outside of just economic data. So obviously a big advocate for home ownership. There's a lot of reasons why it makes sense, but building equity, managing growth to build wealth, so that when you're in your later years, you're in your later chapter, you could potentially have a free and clear asset that might be worth hundreds of thousands of dollars as a result of you making mortgage payments every month most of your life. Now you have this asset and you could do something with it, like sell it, borrow against it, leverage it for your retirement, take out a reverse mortgage to fund your senior years. So a lot of options, but homeownership clearly outperforms renting on all the scales, all the models.
Yeah, I agree, because I think sometimes people say, oh, well, I'm renting, I don't want the headaches of maintaining a home. Well, those headaches will still happen, and you have to have a reliable landlord that will want to fix those headaches. And good luck with that with some of these property management companies. I know some of the larger ones here in the Tampa Bay area, well, they might fix your problem maybe halfway. They might put a Band-Aid on it. And then you're always at the will of someone else. If they want to raise your rent, they will. And, with a mortgage, you know what your payment is, you know what your taxes are, they do send that in the mail, and then a lot of these, there are lots of tax benefits to homeownership where you're not going to get those benefits if you're renting. With student loans and car payments at all-time highs, how debt heavy can a borrower actually be and still get a yes from the underwriting department?
Yeah. So different programs have different allowances for debt to income. So a VA buyer is going to have the widest range for debt allowances. If you are a veteran, military, active duty, former military, you have VA eligibility, that's going to have the broadest range for debt to income allowances going up into the high 60s. We've seen debt to incomes exceed the high 60s. For the rest of the population, 50% of what we call a debt to income ratio is the standard as a guide. There's some nuances to that, but what that means to break it down as a math figure, if somebody earns $10,000 a month, right, in earnings, and their monthly debt, their mortgage payment, their car, their credit cards, if they all amount to $5,000 a month, we have $5,000 divided by $10,000 monthly, that becomes their debt to income ratio. So in that example, that person would be maxed out on their debt to income allowance, but 50% is going to be the magic number. There's some other advocates out there that would like to see that a lot lower, like Dave Ramsey followers. He tries to tell people, hey, you really need to be, in a 36% debt ratio on a 15-year term. Tough to do in this housing environment, but the lower the better, but banks will allow you to go up to half of what you make on a monthly basis to include your debt.
Well, and there are other options. So if you are an investor like I am, and you don't want your income to play into the ratio at all, there's a loan called the DSCR loan, the Debt Coverage Service Ratio loan, where your personal income isn't taken into account pretty much at all, but the income the property brings in. Can you talk a little bit about those loans?
Sure, yeah. So we're qualifying you not on your individual earned income, we're actually qualifying the property on the income that the property can produce, and banks do that with the confidence level that the income that the property produces is going to offset the mortgage debt on the property. So you can actually get approved for a home without showing any income. Still have to have credit, but without showing any income, you can get approved for an investment property as long as the market rent supports covering an amount close to, or let's call it within 75% of your mortgage debt on the property, and you can get qualified for that home without having to show a W-2, a tax return, a pay stub, etc. So those are typically going to be in the 20% down range for what we would call normal standards for, I don't want to use the word a no income verification loan, but it kind of is. It kind of is a no income verification loan. We qualify it off of the property rather than the individual. Very popular, by the way, for people to build their rental portfolio to use these types of loans.
Yeah, I know I personally enjoy them because I've been a 1099 for probably at least 6 years now, and this is the way that I got into the real estate market. And I really want to encourage individual investors that actually care about their properties to become landlords, because we have to fight against large conglomerates like BlackRock and State Street trying to take over these neighborhoods. Because the more individual landlords and homeowners that we can be, the better our communities will be, and the better our reputation, or the better the rental market reputation will be in the future. And you wrote the Know Before You Go book here, and it's a 3-step guide to home financing. What is one thing in that guide that consistently shocks your clients once they realize how the industry actually works?
Well, there's a lot of content in there. I would say the one thing that both buyers and real estate agents alike, buyers agent, sellers agent, the number one thing is preparedness. So barring all the pieces to home ownership around credit, income, asset preparation, the primary hiccup for everybody is just getting approved, getting prepared, knowing how much you make, knowing what your credit looks like, knowing what money you have accessible So I would say just the concept of learning about the strength of getting pre-approved and understanding your buying power before, keywords, before you start the home hunt. A lot of people start the home hunt, they get excited, they want to buy the home, it's a Sunday at 5 o'clock, the phone rings, we want to make the offer, my wife loves the crown molding and the hardwood floors, and then they say, oh, but we don't show any income, and then it's like we're just starting over. So if you're going to be in the home hunt in the next year, talk to a professional lender, get pre-approved, or find out what you need to do in order to be approved. So the book, No Money, No House, I wrote is really, it's about preparedness. It's about just getting started. I said the first step in home ownership is to just stop. Just stop doing everything. Don't advance new credit. Don't borrow money. Don't transfer money around. Don't quit your job. Just stop and just take an account, take some assessment for what you have going on with your credit, your income, and your assets. When I say your assets, like what money do you have accessible, not how much, I don't know, how much equity you have in your truck, let's say. So when we say assets, we're talking about real money that you can actually spend on closing day to invest in a new home. So No Money, No House, the 3-step guide to home financing is actually about getting started with being prepared. So
Yes, and this goes all the way till past the closing table and the recording process. Because I've heard nightmare stories as a realtor about people getting pre-approved, their loan's already underwritten, everybody's ready to go, and then they go buy a new car the day before closing, or they decide to buy that $50,000 worth of furniture the day before closing, and now their debt-to-income ratio has been all messed up, and they run those numbers all the way up until recording. So you do not want to botch your loan thinking that it's already in the bag and good to go. Keep everything level, steady, and even and on the same trajectory until that deed is recorded. You don't want to mess up. FHA loans get a bad rap for being expensive because of PMI, private mortgage insurance. Mm-hmm. What is a scenario in 2025 where an FHA loan actually beat a conventional loan for a first-time home buyer?
Yeah, it's happening every day. So FHA interest rates are lower than conventional rates. Lately, they've been a lot lower. So we can offset what she's referring to, PMI, principal mortgage insurance. That's a standard with FHA loans. In some examples, the PMI is actually lower on FHA loans than it is on a conventional loan, depending on your credit score, depending on your down payment. So in a lot of cases, we have qualified buyers coming in to purchase a home using conventional financing, and we're, let's say the word steering because that's not compliant, but we're encouraging and exploring the opportunity to utilize the FHA loan product due to its lower interest rate environment, due to its ease of approval, it has an expanded criteria for approval, and that there's a refinance opportunity. The FHA has what's called an FHA streamlined refinance, which is a very easy, almost like a no-doc type of refinance, allowing somebody to do a rate reduction. So a lot of benefits to an FHA loan. I see a lot of listing agents avoiding them. They get nervous. They think there's something weird going on. They're going to ruin the appraisal. The closing paperwork is going to be too much. I've heard all of the excuses, but an FHA loan, especially in today's environment, is a stronger loan. It's a stronger offer than a conventional offer because it's allowing for more, it has more grace for things to go sideways. So on a conventional loan, an income verification comes in a little bit off, or maybe a credit debtor or student loan reporting is a little bit off. That could throw the whole approval sideways. Whereas on an FHA loan, they typically have room for those types of issues. They also allow for a little bit more of a tarnished credit profile. Collection accounts, charge-offs, things like that are more acceptable for FHA. So depending on the day, depending on the credit score, depending on the down payment, FHA could have a lower rate and a lower payment.
So that just means get with your lender and explore all of your options. Well, Jim, I'm going to ask you to look into your 2026 crystal ball.
Uh-oh.
And if you could look and see where are we going to be headed the next 12 months from now in the mortgage market?
Well, that's the what do they say, the 10,000-pound elephant or gorilla? So it's a common question. I'm not going to answer it in my own opinion because my opinion doesn't matter, but what's out there as far as data and very intelligent economic forecasters that know a lot more than myself, presidents of the MBA, president of NAR, CoreLogic, some of the brightest institutes in the country, they're all expecting rates to stay and kind of hover in the low sixes is the expectation. So they're going to call that a low or softening market, but not a decrease and not a decrease in rates too much and not a robust market in home sales too much. So we're going to see a lot of the same that we had this year, only we expect with the new Fed chair potentially taking office, with the potential of having reduced quarter of a point federal funds interest rate reductions, that we're going to say slow, grind through each month, sliding scale of a lower interest rate environment that's slowly going to get more and more people off the fence and realize that I can't wait. The wait could be too long. let's go ahead and engage in home ownership. We can always refinance down the road. So 2026, a little bit of what we had in 2025, a little bit of a break in interest rates, and all expectations in most markets are for houses to stay steady. A little bit of decline in certain regions, a little bit of increase in certain regions, but nothing drastic increasing or nothing drastic decreasing that we're seeing on the scale.
Yes, and for the Tampa Bay market, Hillsborough County, Pinellas County, we have been seeing definitely not a 2008 style scenario. Everything is pretty much even keel. We are still in a slight seller's market right now, headed into 2026. If anything, it'll probably become an even market. So if you're waiting to buy a home, you don't need to keep waiting, because not much is probably going to change in 2026. So look at all your options, figure it out, and Jim is here to help you at Union Home Mortgage, and we could get you quotes and things, and he can help you with all of his knowledge. Where could they get your books?
On Amazon, you can Google them under Know Before You Go, or you can look it up under No Money, No House. They're available on Amazon, or you can call me individually at 631-252-8500, and we can do a free consultation. It all starts with getting started. So that's how I'll leave it. Is the best place to get started is to just get started. So make the phone call, talk about a pre-approval, get referred to a real estate agent like Angelique, and start your home hunt, whether you're going to buy next month or next year. The more informed that you are today, the more educated of a decision you'll be able to make when you see the right home.
Well, that's wonderful. Thank you for joining here on Powerhouse Realty Florida's YouTube channel. We enjoyed having you. Next time, like, share, and subscribe, and we'll see you then.